Good morning, dear learners, and welcome to the MOOC on Indian economy, policy and environment. And we are in Module 9, Money, Banking and Prices. And within this module, we are in Unit 3 now, Money and Monetary Policies. So basically, in this unit, we shall be discussing about evolution of the concept of money in India since independence, then the evolution of monetary policies in India, then the role of the Reserve Bank of India in controlling money, inflation, and monetary policy. Then we shall be also discussing a critical assessment of the role of government and the Reserve Bank of India in the control of money and design or adoption of monetary policies in India. And finally, we will be discussing the summary of our discussion. So if you look at the evolution of the concept of money in India since independence, we will see the concept of money in India has undergone significant transformation since the country gained independence in 1947. From a predominantly agrarian economy with limited monetary circulation to a modern, digitalized financial system, this evolution of money in India reflects broader economic, political, and technological changes. So, in this unit, we shall explore the trajectory of money in India, examining key phases such as the post-independence period, economic liberalization in the 1990s, and the recent push towards digitalization. The discussion also highlights the role of policy interventions, technological advancements, and globalization in shaping the monetary landscape in India. Now, if you consider the post-independence period, and this is basically the foundation of a modern monetary system for a country. So, at the time of independence, India's monetary system was characterized by a mix of traditional and colonial structures. The Britishers has established a centralized banking system with the Reserve Bank of India being established in 1935. However, the economy was largely cash-based with limited penetration of formal banking services. The immediate post-independence period saw the government prioritized economic self-sufficiency and social equity, which influenced the evolution of money and financial systems. So one of the major steps was the introduction of the Indian rupee as the official currency replacing the colonial monetary system. The RBI played a pivotal role in regulating the supply of money and ensuring monetary stability. However, the economy faced challenges such as inflation, foreign exchange, shortages, and a lack of financial inclusion. And these things we have already discussed in other units as well. So to address these issues, the government implemented policies aimed at expanding the banking network and promoting savings among the Indian people. So the nationalization of the major banks in 1969 and 1980 was a landmark move in this direction, as it brought banking services to rural and underserved areas, thereby increasing the circulation of money in the formal economy. So during this period, the concept of money was closely tied to physical currency, with coins and banknotes being the primary mediums of exchange. The RBI introduced various denominations to cater to the needs of a diverse population of the country. However, the formal economy continued to thrive with barter systems and informal credit networks coexisting alongside formal monetary systems. So this duality highlighted the challenges of achieving full monetary integration in a vast and heterogeneous country like India. Now, when we move to the economic liberalization phase and how the transformation of money happened in the country, we'll see that the economic liberalization of 1991 marked a turning point of India's monetary history. Faced with a balance of payment crisis, the government embarked on a series of reforms aimed at opening up the economy, deregulating industries, and integrating India into the global financial system. These reforms had profound implications for the concept of money, as they facilitated the flow of capital, increased foreign investment, and modernization of the financial sector. One of the key outcomes of liberalization that we started since 1991 was the proliferation of electronic banking and non-cash payment systems. The introduction of credit and debit cards, automated teller machines, as we call it ATMs, and electronic fund transfers revolutionized the way money was accessed and transacted in the country. These developments reduced the reliance on physical currency and laid the groundwork for a more efficient and inclusive financial system. The RBI played a crucial role in regulating these new technologies and ensuring their safe adoption. Another significant development during this period was the emergence of capital markets as a key component of the monetary system. The establishment of the Securities and Exchange Board of India, as we call it SEBI, in 1992 provided a regulatory framework for stock exchanges and other financial institutions. These enabled individuals and businesses to invest in financial instruments, thereby diversifying the cost of money beyond physical currency. The growth of mutual funds, insurance products, and pension schemes further expanded the scope of monetary transactions, making them more complex and interconnected. So, globalization phase also influenced the concept of money in India by increasing the flow of foreign currency and remittances. The rise of information technology and business process outsourcing, the BPO industries, created new avenues for earning foreign exchange, while the diaspora contributed significantly to the economy through remittances. This integration with the global economy necessitated the adoption of international monetary standards and practices, further modernizing India's financial system. Now, if we say about the digital evolution and the future of money in India, we will see that the 21st century has witnessed a paradigm shift in the concept of money, driven by rapid technological advancements and changing consumer behavior. The advent of digital payment systems, mobile banking, and fintech innovations has transformed the way money is stored, transferred, and utilized. India's push towards a cashless economy gained momentum with the launch of the Unified Payments Interface, UPI, as we call it, in 2016, which enabled seamless real-time transactions through mobile devices. This initiative, coupled with the proliferation of smartphones and internet connectivity, has democratized access to financial services and reduced the dependence on physical currency. The demonetization of high-value currency notes in 2016 was a controversial yet pivotal moment in India's monetary history. Aimed at curbing black money, counterfeit currency, and tax evasions, the move led to a temporary cash crunch but accelerated the adoption of digital payment systems. The government's emphasis on financial inclusion through initiatives like Jan Dhan Yojana, Aadhaar, and mobile banking has further strengthened the digital infrastructure, making money more accessible and transparent. Now, cryptocurrencies and blockchain technology represent the next frontier in the evolution of money that have recently evolved. While the regulatory framework for cryptocurrency remains uncertain, in India, their growing popularity underscores the need for a nuanced understanding of digital assets. The RBI's exploration of a central bank digital currency, in brief we call it CBDC, reflects the potential for integrating traditional and digital monetary systems. So these developments highlight the dynamic nature of money and its ability to adapt to changing economic and technological landscapes. Now, if we see the evolution of monetary policies in India since independence, we will see in a lecture note delivered by Sri Shaktikant Das, former governor of RBI in 2020, has categorized the evolution of monetary policy in India in 7 phases, namely 1935 to 1949, it's called the initial phase, 1949 to 1969, its monetary policy in synchronizes with the 5-year plans of the country. Then, since 1969 to 1985, credit planning, 1985 to 1998, we can call it monetary targeting, 1998 to 2015, it's multiple indicator approach, 2013 to 2016, preconditions set for inflation targeting, and 2016 onwards, it's flexible inflation targeting era. So, in this section, we shall briefly discuss the major happenings in those 7 phases in India. So, in the initial phase of 1935 to 1949, the RBI was established amid the Great Depression, focusing on maintaining sterling parity by regulating liquidity through open market operations and other tools like bank rate and cash reserve ratio. With an agrarian economy, we are talking about those times, inflation was often tackled through price controls and selective credit measures to curb speculation. Now, in post-independence phase, which is 1949 to 1969, marked a significant shift towards planned economic development characterized by a stronger state role in fostering a socialist society through economic growth and self-reliance. The RBI's monetary policy adopted to support these 5-year plans, prioritizing credit allocation to productive sectors. Although there was no formal monetary framework for this, but a policy aimed to manage credit supply and demand based on developmental needs. Key instruments of this included the bank rate, reserve requirements, and open market operations. The Banking Regulation Act of 1949 introduced the Statutory Liquidity Ratio (SLR), which aided government borrowing and served as a monetary management tool. Overall, while inflation was moderate in the immediate post-independence period, it became a notable concern between 1964 and 1968, necessitating ongoing adjustments in monetary policy. Between 1969 and 1985, India's credit planning underwent significant transformations following the nationalization of major banks aimed at democratizing credit access. This shift promoted RBI to balance economic growth, financing with price stability amidst rising money supply and inflation. Several external shocks, including the Indo-Pak War, droughts, oil price surges, and the Bretton Woods system collapse, exacerbated inflationary pressures on the Indian economy. The domestic economy's high inflation occurred alongside global stagflation, which rendered traditional monetary instruments like the bank rate and open market operations ineffective. Banks benefiting from deficit financing largely avoided borrowings from the RBI, diminishing the bank rate's relevance. Additionally, the underdeveloped government securities market curtailed the effectiveness of open market operations. Consequently, average growth stagnated around 4%, with wholesale price index inflation reaching approximately 8.8% during this period. Now, from 1985 to 1998, fiscal dominance grew due to automatic monetization of budget deficits and rising statutory liquidity ratio (SLR) requirements. This inflationary pressure prompted tighter monetary policies with significant increase in cash reserve ratio and bank rate. The Chakraborty Committee's recommendations led to the formal adoption of a monetary targeting framework in 1985, aiming to control inflation by limiting monetary expansion. So in this framework, reserve money and broad money were targeted with CRR as the primary control mechanism, though continued fiscal dominance saw both SLR and CRR peak by 1990. The fiscal crisis of the late 1980s marked a period of external imbalance and domestic growth failure in 1991-92, driven by global disruptions like the Gulf War and the Soviet Union collapse. So this crisis necessitated extensive structural reforms, financial liberalization, and a transition to a market-driven economy aiming for sustainable growth and price stability. Notably, in 1993, the regime shifted from fixed to market-determined exchange rates. As trade and financial reforms spurred foreign capital and innovation, the stability of the money demand function and the efficiency of broad money as an intermediate target were called in question, marking a shift toward market-based financing. The automatic monetization via treasury bills ended in 1987, transitioning to a system of ways and means advances with the average domestic growth at 5.6% and inflation at 8.1%. Now, if we see that period from 1990 to 2015, the Reserve Bank of India adopted a multiple indicators approach, responding to inadequacies of existing monetary targeting framework. So this approach incorporated various forward-looking indicators for monetary policy formulation. The introduction of Fiscal Responsibility and Budget Management (FRBM) Act in 2003 enhanced fiscal disciplines and flexibility in monetary policy. Now, with increasing market orientation and interest rate deregulation, emphasis shifted from direct to indirect monetary instruments, making short-term interest rates central to the RBI's policy signaling. The RBI took measures to stabilize short-term rates by integrating money markets and adjusting liquidity through various policy tools. Between the period of 2013 and 16, The Reserve Bank of India addressed challenges to its monetary policy framework due to high inflation and slow growth followed by 2008 financial crisis. The US Federal Reserve's tapering discussions in 2013 put pressure on India's monetary discussions, leading to criticisms of the existing multiple indicator approach for lacking a clear nominal anchor. To reformulate the framework, the RBI established an expert committee that decided inflation as the primary anchor for monetary policy in its 2014 report. Subsequently, the RBI committed to reducing inflation sequentially from its November 2013 peak of 11.5% to 5% by quarter 4 of 2016-17. So from 2016 onwards, a monetary policy framework agreement was signed, enabling a flexible interest targeting regime officially adopted in May 2016. This mandate emphasized maintaining price stability primarily with a target of 4% consumer price inflation and a tolerance band of plus minus 2%. That means here and there plus or minus 2%. So this approach allows the RBI to emphasize growth while controlling inflation, adapting based on the macroeconomic context. Since implementing FIT, flexible inflation targeting, inflation has typically remained below 4%, despite occasional spikes driven by factors such as food prices due to weather-related disruptions. The RBI has continued to enhance its monetary policy transmission and communication during this period. Thus, on overall, we can say that the macroeconomic outcomes indicate that the multiple indicator approach was effective from 1998-99 to 2008-9, during which the average domestic growth rate rose to 6.4% and WPI, wholesale price index-based inflation, decreased to 5.4%. However, in the aftermath of the global financial crisis post-2008, the credibility of this framework was challenged due to the coexistence of persistently high inflation and weakening growth. The situation worsened during the period of double-digit inflation in 2012-13, compounding by the US Fed's tapering signals in mid-2013, which created significant hurdles for domestic monetary policy as it sought to balance growth, inflation containment, and also financial stability. So critics argued that the multiple indicators approach lacked a clear nominal anchor necessary for effective monetary policy. So in response, the Reserve Bank of India established an expert committee aimed at revisiting and enhancing the monetary policy framework to ensure greater transparency and predictability. The committee's 2014 report assessed the existing approach and proposed that inflation be adopted as the nominal anchor for India's monetary policy framework, signaling a significant shift towards inflation targeting to address the challenges faced in the post-global financial crisis environment. Now, let us discuss the role of the Reserve Bank of India in controlling money, inflation, and monetary policy. And some of the discussions we have already undergone, but this will be a more focused one. Okay. So, tasked with regulating currency, managing inflation, and ensuring financial stability, the RBI's role has evolved in tandem with India's socio-economic transitions. From navigating post-colonial economic fragility in steering liberalization and embracing globalization, the RBI has balanced development objectives with price stability. In this section, we shall try to analyze the central bank's efficacy in controlling money supply, curbing inflation, and formulating monetary policy over the past 7 decades, contextualizing its strategies within India's broader economic narrative. So if you see the first phases of 1947 and 1960s in the post-independence era, we will see that in the early years of independence, India inherited a war-ravaged economy marked by food shortages, low industrialization, and limited financial infrastructures. So the RBI's primary focus was to stabilize the monetary system and support state-led development. The central bank adopted a conservative approach, prioritizing the management of currency and credit to align with the 5-year plan's objectives. A fixed exchange rate regime pegged to the British pound was maintained to ensure external stability, while directed credit policies channeled funds to agriculture and small industrial sectors. However, the RBI's autonomy was constrained by fiscal dominance. The government's reliance on deficit financing, printing money to fund expenditures, led to inflationary pressures. For instance, the wholesale price index, WPI, surged by 13.8% during the 1956-57 drought. The RBI responded by tightening credit through higher cash reserve ratios and moral suasion, but these measures had limited success due to structural bottlenecks like agrarian dependency on supply side inefficiencies. The 1966 rupee devaluation by 36.5% underscored the RBI's struggle to balance external viability with domestic price stability as the devaluation fueled import-led inflation. Now, if we see the bank nationalization and directed credit phase of 1970s to 1980s, we will see that the nationalization of 14 major commercial banks in 1969 marked a paradigm shift in the RBI's role in the banking sector. The move aimed to democratize credit, reduce regional disparities, and prioritize lending to agriculture and marginalized sectors. So by 1980, public sector banks controlled 90% of the banking assets, with rural branch expansion increasing from 22% in 1969 to 58% by 1990. While this enhanced financial inclusion, it also led to operational inefficiencies. Directed lending targets, such as the 40% priority sector lending mandated, often resulted in non-performing assets, weakening the bank profitability. The 1970s oil shocks exacerbated inflationary pressures on the economy, with WPI inflation peaking at 25.4% in 1974, while in the previous it was nearly 24%. The RBI resorted to stringent monetary controls, including mandating the banks to maintain additional CRR above the normal limits and selective credit restriction on sensitive commodities like food grains. However, fiscal profligacy, evident in the government's expansionary budget, undermined these efforts. The Chakraborty Committee in 1985 highlighted the need for monetary policy reforms, advocating a shift from credit rationing to market-based instruments. Despite this, the RBI's tool remained blunt, as administered interest rates and quantitative controls stifled financial innovation. Now, if we see the liberalization and monetary policy modernization phase of 1990s and 2000s, we will see that the 1991 balance of payment crisis forced India to liberalize its economy, reshaping the role of the RBI. The rupee transitions to a managed float regime in 1993, granting the RBI greater flexibility in exchange rate management. Financial sector reforms, guided by the Narasimha Committee of 1991, reduced CRR and SLR, freeing up bank resources for productive lending. The RBI phased out ad hoc treasury bills in 1997, curtailing automatic monetization of deficits and enhancing monetary independence. The 2000s, on the other hand, saw the RBI adopt a multiple indicator approach we have already talked about in the previous section, indicating various variables like inflation, growth, and exchange rates into policy decisions. The introduction of the liquidity adjustment facility in 2000 allowed fine-tuning of short-term liquidity through repo and reverse repo rates. Despite these advancements, the RBI faced criticism for its reactive stance during the 2008 global financial crisis. While emergency liquidity injections and the rate cuts stabilized market, they also fueled asset bubble, with CPI inflation averaging 9.5% between 2009 and 2013. A landmark shift occurred in 2016 with the adoption of the formal inflation targeting framework. Okay, when we will see the 2016 till present, we see these things. And we also see that the RBI and the Government of India signed a monetary policy framework agreement mandating the central bank to maintain CPI, consumer price inflation, at 4% plus minus 2%. Okay, plus 2% or minus 2% in between this. A 6-member monetary policy committee comprising the RBI and government nominees was established to democratize rate setting decisions. This institutionalized transparency with MPC meeting and minute publicly disclosed to anchor inflationary expectations. Empirical studies suggest mixed outcomes. While CPI inflation averaged 4.9% between 2016 and 2020, structural issues like food price volatility and supply chain disruption during the COVID-19 pandemic tested the framework. The RBI's response to the pandemic, slashing the repo rate to 4% and injecting 6.7 trillion rupees via long-term repo operations, highlighted its dual focus on growth and stability. However, critics argue that prolonged accommodative policies risk fueling inflationary pressures on post-pandemic with consumer price inflation breaching the 6% upper threshold in 2022. Now, if you see how the managing of supply and financial stability was done, you will see that controlling money supply has been central to RBI's inflation mandate. In the peace reform era, directed tools like CRR, cash reserve ratio, and SLR dominated, with CRR peaking at 15% in the 1980s. So, in post-liberation, indirect instruments such as open market operations and policy rates gained prominence. The RBI's ability to manage liquidity was tested during demonetization of 2016 when 15.4 trillion rupees of high-value currency was invalidated overnight. While the move aimed to curb black money, it disrupted money supply with M3 growth plunging to 3.6% in Q4 of 2016. The RBI has also prioritized financial stability, particularly after 2008 financial crisis. Macroprudential measures like loan-to-value ratios for housing loans and counter-cyclical capital buffers were introduced to mitigate systemic risk. The establishment of the Financial Stability and Development Council in 2010 further institutionalized inter-regulatory coordination. Now, if we see the digital transformation and future challenges, we will see that in the recent years, RBI have embraced digital innovation to enhance monetary policy transmissions. The Unified Payments Interface, launched in 2016, revolutionized digital transaction, processing over 10 billion monthly transactions by 2023. The RBI's pilot launch of central bank digital currency, the ER, that is electronic rupee, in 2022 aims to reduce cash dependency and improve payment efficiency. Now let us view a critical assessment of the role of government and the Reserve Bank of India in the control of money and in design and adoption of monetary policies in India. The management of money and monetary policy in India is a shared responsibility between the Government of India and the Reserve Bank of India. Since independence, both institutions have played pivotal roles in shaping the country's monetary landscape, ensuring economic stability and fostering economic growth. However, their roles and interactions have often been marked by challenges, conflicts, and evolving dynamics. So in this section, we shall try to critically assess the roles of government and the RBI in matters relating to money and monetary policy, examining their success, limitations, and areas of contention. So the discussion is framed with the broader context of India's economic developments and the changing global financial environment. Since establishment, one of the RBI's most significant contributions has been its role in maintaining macroeconomic stability. During periods of economic crisis, such as the balance of payment crisis in 1991 and the global financial crisis of 2008, the RBI implemented prudent monetary policies to stabilize the economy. For instance, during the 2008 financial crisis, the RBI introduced interest rates and injected. During 2008 crisis, the RBI reduced interest rates and injected liquidity into the system to mitigate the impact of global downturn. These actions underscored the central bank's ability to act as a stabilizing force in times of uncertainty. However, the RBI's effectiveness has often been constrained by external pressures and structural limitations. For example, the dual mandate of controlling inflation and promoting growth has sometimes led to conflicting priorities. Critics argue that the RBI's focus on inflation targeting, formalized through the Monetary Policy Framework Agreement in 2015, has come at the expense of growth, particularly in the periods of economic slowdowns. Additionally, the transmission of monetary policy decisions to a broader economy has often been inefficient, with banks delaying adjustments in lending rates despite changes in the repo rate. Historically, if we see the government's role in monetary and fiscal policy, we will see that historically the government's fiscal policies have sometimes undermine the RBI's monetary policy objectives. For example, during the 1980s, high fiscal deficits and excessive money printing led to inflationary pressures which the RBI struggled to contain. Similarly, the demonetization exercise of 2016, initiated by the government, created significant disruptions in the monetary system, with the RBI facing criticisms for its implementation and lack of preparedness. On the other hand, the government has also taken steps to complement the RBI's efforts in promoting financial inclusion and stability. Initiatives such as the Pradhan Mantri Jan Dhan Yojana (PMJDY), which aim to provide banking access to the unbanked population, and the introduction of the Goods and Service Tax (GST), which streamline indirect taxation, have had positive implications for monetary policy. So these measures have enhanced the formalization of the economy, improved tax compliance, and increased the efficiency of the monetary interventions. Now, if we see the coordination and conflicts between government and RBI, we will see that the relationship between the government and the RBI has often been characterized by a delicate balance of cooperation and conflict. While both institutions share the common goal of economic stability and growth, their approaches and priorities have sometimes diverged. For instance, the government's focus on stimulating growth through fiscal expansion has occasionally clashed with RBI's emphasis on controlling inflation through tight monetary policy. One notable area of contention has been the issue of central bank independence. The RBI's ability to operate autonomously is critical for maintaining credibility and achieving its monetary policy objectives. However, there have been instances where the government have been perceived as encroaching on the RBI's autonomy. For example, the resignation of RBI Governor Urjit Patel in 2018 was widely seen as a result of tensions between the government over issues such as transfer of RBI reserves and the handling of the non-performing assets in the banking sector. Despite this conflicts, there have also been examples of successful coordination between the two institutions. The establishment of the Monetary Policy Committee in 2016, which includes representatives from both RBI and the government, has institutionalized a collaborative approach to monetary policy formulation. This framework has announced transparency and accountability while also ensuring that diverse perspectives are considered in decision making. Now let us look at certain challenges and future directions. We will see that the evolving economic landscape presents new challenges for both government and the RBI. The rise of digital currencies, the increasing complexity of financial markets, and the need for sustainable development requires innovative approaches to monetary policy. The RBI's exploration of a central bank digital currency and its efforts to regularize fintech innovations reflect its adaptability to changing circumstances. However, these initiatives also necessitate close coordination with the government to ensure regulatory clarity and alignment with broader economic goals. Another critical challenge is addressing the persistent issue of financial inclusion. Despite significant progress, a large segment of India's population remains outside the formal banking system till now. Bridging this gap requires concerted effort from both the RBI and the government, leveraging technology and policy interventions to expand access to financial services. So with this, we have come to the end of this discussion. And so dear learners, in the above discussion, we have seen that India's monetary evolution showcases a blend of policy innovation, structural reforms, and technological adaptations. The RBI has transitioned from its post-independence regime to a modern inflation targeting framework, addressing challenges while promoting financial inclusion and stability. Now, the future goals in this direction include tackling climate-related financial risks, improving cybersecurity, and ensuring equal access to digital services. So, in a nutshell, in the past 75 years, the RBI has grown from a passive regulator to a proactive institution, effectively managing hyperinflation and modernizing monetary tools. However, it faces structural constraints like fiscal dominance and global uncertainties. So, as India aims for a 5 trillion economy, reinforcing institutional autonomy and leveraging technology will be crucial. The relationship between the Government of India and the RBI highlights the need for collaboration in policy making for sustainable growth. So finally, with this, we come to the end of this unit, and in the next unit, we shall primarily focus on prices and inflation in India. Till then, happy learning. Thank you.